Certainly. Good morning, everyone. Great to be with you. Great to be back at ASI again. Have to say from Chicago that I would much rather be on the Gold Coast and in person with fall coming here, but we'll do what we can. I'm delighted to represent our group within Mesirow Financial. We've been in the currency markets 30 years, 92 billion in passive, active alpha strategies, and a 24-hour trading desk that help us navigate quite a bit, including the most recent COVID impacts to the marketplace. So what I'd like to do, and Troy, thank you for the tee up, is really talk about three facets with a focus on more of a structural passive hedge. And interesting hearing the polling notes, most superannuations will have a passive core, but will vary it. So I think that may be why the polling numbers were structurally pretty high. So three things I'd like to accomplish this morning. One, just give you specific to currency backdrop on what has happened to the Australian dollar, both short-term, long-term, look at volatility implications for the market, especially with the COVID affected period. And then transition to talk about what are clients doing and why, from the context of an Australian superannuation plan to then how do they implement. And then lastly, just talk about through this chapter, the last 9 months, how those clients have navigated a structural hedge. So liquidity calls and other demands, what have been refined in that process. So I will take us from here. Now this chart again is a little bit busy. Hopefully you can see it in good detail, good resolution on your screen. But the purpose here is just to show you the impact, some important news dates overlaid against Australian spot price. So we come into the year at the end of 2019, we were just a hair over 70 in the Aussie dollar. And then you have a series of events that obviously took place and opened all the markets and all of our eyes to the risk of a pandemic. The first death in China took place on January 13th. The first case in Australia was later in January on the 27th. And then this picture unfolded with the WHO formally declaring a pandemic in early March. You see this dark shaded area going from 70 down to actually a low of 55.10. That classic risk off environment as the magnitude of the pandemic, the shutdown of the economy, both a supply and demand shock began to ripple through the markets. It's interesting at the bottom of the slide when you look at China cites no new cases in the first phase on March 19th. That was actually the low of the Aussie dollar. And even as you look toward the right-hand arc of this chart, the news continues to get worse, broader spread, but markets are adjusting because central banks are using monetary fiscal policy to encourage more of a risk-on environment. So that 21% fall in the Aussie dollar to 55.10 was followed through September, mid-September, a 32% increase. So massive risk on, massive risk off. Looking at a little longer term in the next slide, we've got a more broad valuation metric sticking with Aussie dollar. And if you look at this slide, it can be intuitive to say if the shaded area is above zero, that's when Aussie is relatively strong. So the purchasing power, OECD purchasing power, is stronger relative to the US dollar. And then when it's below, it's weaker. You can see from 2010, 2011, there's been a structural weakening of the Aussie dollar versus the US dollar. But what's even more interesting is to look at the shocks. If you look at mid-2008, there in the left-hand side of the middle of that chart, you'll see almost a 40% drop due to the GFC. It took 17 months for that to recover. While the pain that we've been in from a PPP metric on the Aussie dollar now has been less, it's still about 14%. The good news has been the roarback has been pretty quick, 6 months to recapture that. So you can see the variation starting the year about fair value, dropping to 12% undervalue, and now you're back up positive plus 6%. Looking at volatility, as I mentioned, not only in the equity markets with VIX, but also in implied Aussie dollar vol, 3-month vol. Equity market vol actually hit an all-time high. You wouldn't think that would occur over and above the GFC, but it did, a hair over 82 for the VIX. More importantly, looking at currency, and that's our topic today, you look at the increased percentage increase, the volatility of COVID actually was up 300% from the prior vol regime, and that's about 50% greater than it was in the GFC. So these are historic times. We've all felt the pain, but it puts the context of the shocks that we've been through on the table. If you think about, okay, what has that done? What has that done to the FX market when you're trying to implement hedging strategies, risk protection? The most important thing to look at is, there's been a flight to quality, the flight to the US dollar that has caused that material and structural check down of the Australian dollar. And if you're hedged and you have a passive hedge position, that's created immense liquidity concerns. Second, you're looking at the volume actually is in the last 5 years, it hasn't been this high since the Swiss National Bank lifted the peg. So we've got massive volume in the markets with not only superannuations, corporates, and others entering to hedge or refine their hedge profiles, and as well as other market participants. So that's been a huge effect. It's affected liquidity. I think one of the things that for our team, our 24-hour desk, having access to everything from direct relationships to platforms to algos, it's really put a strain to make sure that you've got access to everything. And those long-standing relationships in the banking market, we have anecdotally 21 plus relationships with global banks. Having that access has been key. Spreads have widened significantly through March. So what was a half pip in December in terms of spread execution, gapped out 3 to 4 times. So that's noticeable. Obviously, it's painful, but it has come back in, not quite to the late 19 levels, but it's very, very constructive as we now look. And then lastly, it's what time is the market deepest, and looking at that with some granularity through our third-party provider. Morning hours in the UK, all the way through when the overlap of New York and London has been huge. So that's been where you're able to execute most efficiently for the client base. I'll move to take a bit of a step back and look at the context, try to summarize that from a risk management, principally passive hedging structure for Australian superannuation market. A couple of quick themes. One, risk is increasing in currency. The global asset allocations have brought about the byproduct of currency over the last decade that is growing, as plans are in a low rate environment forced to look at best opportunities that may not be in the home equity or debt markets. So that's huge. Second, and it's well known, currency, especially for developed exposures, is typically a zero-sum game. So if you have risk volatility from having those holdings, those exposures, if you're not compensated for it, there is an obvious structural position to have some sort of hedge on. And then lastly, and I think this ties into the poll question, many plans superannuation plans with a Aussie base want to have exposure to currency for the very reason of the Aussie dollar being risk-based, meaning they want to have exposure. So when the Aussie dollar falls, that can be a diversifier, a counter lever in times of stress. So we did a pre-poll week or so ago for clients, prospect, investment consultants, and the vast majority, 50 or so percent, target that 20 to 30% at a plan level of exposure. The next category down would be between 10 and 20. And those two categories combined are about 80% of the respondents to the survey. So having that intentional exposure to currency is an important dynamic to the process. Taking it to how it's implemented, very important to have volatility reduction. We polled our clients. That's number one for them. The other two are best execution, with RG97 making sure you're driving down cost, trading cost, and then thirdly, management fees. So those are supremely important. I think the other element to a plan that we see is working very closely with investment staff, asset consultants to say, when would that structural hedge be varied? Would you, when the Aussie dollar is particularly weak, would you want to raise that hedge profile? When the Aussie dollar is particularly strong, would you want to lower it? So that is an active dynamic that can be embedded into this type of framework. And I feel like that's the most consistent application that we see. 40% of our assets are in Australia, and very, very conversant with those issues and those dynamics. So those are the objectives, and I'll wrap up in the last couple minutes just talking about how has this been navigated? How's the market with COVID, with these type structures in place? How has that performed? What are the pressure points? What are the refinements, honestly? And I think you really start at the top with saying, with the policy of early access to superannuation, that one policy lever, in addition to equity markets declining, Aussie dollar falling with the hedge position leading to billions in for some plans of cash call, it's the policy change to allow members access that's been the most unique and challenging. So you have to then step back at the entire mosaic of issues of liquidity, from policy to equities to cash flow from hedging, negative cash flow from hedging, and have a plan. The key elements that we've seen is, pushing out the maturity of negative settlements. Obviously, you crystallize what you have in a volatile market, but many plans were having them move that out 9, 12 months, so that not to change the characteristic of that loss, but to give plans ample time, ample planning, and hopefully the rebound of markets so that they're not selling assets at a low to carry that negative settlement. In the converse to that, in the second half of post-March, when Aussie dollar was rallying, when you have a profit from your hedges, it's also very important to look at the NPV, the net present value of that cash position, to accelerate cash to the plan. So pushing off cash obligations, accelerating cash indebted or owed to you to be able to smooth that out. Lastly, we've seen a couple of themes that we'll probably take on a little bit more in the Q&A, but one is our plans have learned a lot from the GFC in terms of applying staggered maturities, but are they expanding their tools of use now to include options, to look at other things, to make sure that liquidity is being managed optimally? So we are seeing that thread as a complement to an overall hedging structure using the forward market, but looking at and implementing options has been a big thread. Lastly, emerging markets exposure. If you look 10 years ago, very, very few plans endeavored into hedging that or even evaluating it. We're seeing that really flip on its head. In the market now, we see 8 out of 10 superannuation plans not hedging EM currency, so being unhedged in that regard. But we see half of the people, whether it's asset consultants, existing clients, and others, evaluating that to say, is the negative carry worth it? Can we take and protect risk in EM, which is growing much more significantly? So hopefully in that real quick snapshot, giving you the context of what we've been through, not only this year, but longer term, how plans are designing it, what are their objectives, and then how are we refining those things.